Hey everybody, welcome to the Thursday edition of the Financial Thing Investing live stream. We are live and direct from sunny Orlando, Florida, where it is about 10,000 degrees. Humidity is 1,000,000%. Getting into the swing of the summertime. Hope you are doing really well. We are having a special guest this evening. Mike Bristow is going to be here just a couple of minutes from Crowdproperty, of course, the UK peer-to-peer lending platform that we speak about so often when we look at the news. And we're going to ask Mike some good questions about what is going on at Crowdproperty, what's going on with the business, how it's growing, where are they struggling, what's going on with the late loans, etc., etc. So if you have questions, put them in the chat. I'll do a Q&A at the end like I always do. Mike is usually very transparent with the questions that he answers, so hopefully he'll give us some insight into what is going on there. And if you didn't see a couple of weeks ago, we had Natalie Weeks here from Cufflink Live. We're going to have more guests coming up over the next period of months, so keep an eye on it for that, and sign up for the Financial Thing mailing list so you get notified, because I don't always put it everywhere, but you can go there, financialthing.com, and fill out your email address and first name on that little box on the right hand side of the top. You'll get notified about all of the live streams that are coming out. And please hit that thumbs up if you can. This is the only place you're going to find these live interviews with the companies that you invest your hard-earned money through, so it takes a lot to get these done. That little thumbs up helps and shows support, etc., etc. So yeah, I don't think that's it. Let's just get right into it today, and no messing around, right? No messing around. I hope the weather is good too in your area. Let me go ahead and call Mr. Bristow up. Let's get him right here. Hold on. The magic of live. Here we go. Hopefully he answers. That would be extremely embarrassing. I see his little picture in my Skype, smiling at me. Oh. Okay. Here we go. Oh, there we go. Hello. Hi, Mike.
Yes. Hi there.
How you? There he is. Okay. Live and in person again. Doesn't look even a day older than the last time I talked to you, which is probably a year ago, maybe. I don't know. How long ago?
I think it was about a year ago. Yes, it feels like an annual event, which I always look forward to. So, yeah.
Yeah. Well, first of all, thank you for taking your time to come and share all the wealth and knowledge about the fabulous Crowdproperty. That's not an official name. I guess it could be if you wanted to rebrand to the fabulous Crowdproperty. But yeah, let's just get right into it. We got some things that we're going to chat about. We're going to talk about obviously what's going on at Crowdproperty, how the business is doing. We've got to touch on the gray skies of late loans that every peer-to-peer platform deals with. I know there's a lot of people out there that have been asking me questions about that, which is kind of why I reached out to you and said, I'm just going to get you here, have you tell everybody what's going on, and maybe calm some nerves a little bit. So what currently is the size of your loan book over there?
So, well, we've been lending for almost 10 years now, so we've got a bucket load of experience under our belts, and we've now backed property projects worth 843 million, funding the development of 3,582 homes, agreeing development finance facilities of 482 million, and that's across 453 projects. And we've lent and money out the door towards those facilities, because you sort of draw those down over time. You don't give the developer all the money up front. It's a crucial element of development finance. always in arrears to work. So the money out the door, £394 million. But I guess the interesting thing there is the number of projects there, 453. Relatively in development finance, that's quite granular, and that gives really good diversification potential for people, which is obviously a really important factor in investing. And therein lies probably one of the facts that I'm most proud of personally, is that on average, our platform investors are invested across 88 different projects. And that's great practice, great risk management, and should something go wrong with individual projects, which sometimes can happen, then that is well diversified and well risk managed. And obviously those numbers are largely about money out the door. As we all know, the most important thing is money back in through the door.
Yep.
So we've had now £237 million paid back, and that's consisting of £217 million of capital, £21 million of interest. And of those 453 projects that we've backed, 315 of them have now paid back in full. And that ultimately drops down to an actual investor return of 8.06%. Now that's from those fully paid back projects, so it looks slightly different to the website because that's on a loan basis. Anyway, on full paid back projects, on average 8.06%. And interestingly there, that compares to get for a like comparison, 8.06% versus 7.83% is the average contract rate. So what you'll see there is a 23 basis points premium, and that premium comes from when loans do go late, and this is development finance, they do go late, we give our investors an extra 2 percentage points of returns for that inconvenience. That correspondingly increases the drive for the borrower to pay back, but that inconvenience is compensated. And so actually we're running at delivering a higher rate of return to our investors than the contracted rate. Mm-hmm. Which is a good thing and a bad thing, right? They are late, but that 23 basis point premium compensates for that. So look, that's a lot of lending. It's a lot of track record. It's a lot of expertise. It's a lot of learnings, and we get better and better every day at what we do.
Okay. And what are the current interest rates on the new loans that you're putting out? What are you offering at the moment?
Well, that's probably it's certainly a really good question, because if I tell everyone that, well, we're delivering actually 8.06%, then given the context of where base rates are globally now, that doesn't sound too inspiring, but that's obviously off the entire history of the book, and that is skewed to loans. Obviously, the last year or so, those development finance loans haven't matured yet, so the higher rates haven't really sort of landed in the actuals yet. But basically, we're offering between 9.5% and 10.5%. Obviously, through the usual channels, you can put SAS pensions into it, ISA, etc. Our product and access to loans in that range, 9.5 to 10.5. That is a loan-based pricing. So whether you're self-select or auto-invest, you get the same amount, or the same return for each loan participation. That's fundamentally, it's the same risk. Mm-hmm. Now, I think the important thing to highlight there is that we're quite nimble with our pricing. We thoroughly market benchmark, and we have very, very standardized monthly market benchmarks that we test our investor rates against. So I'll give you a couple of examples of those benchmarks, not all of them. So firstly, we look at what's called, let's get technical here, SONIA swaps. So it's the overnight, basically overnight lending rates between banks, which on a not a futures, but a static today's rate, it roughly is base rates. However, swaps are what that money might cost over a longer term. So it factors in expected base rate movement. And the reason why real estate as a whole, and we look at swap rates over a 1-year period or a 2-year period, is that effectively your money is deployed for 1 or 2 years, and that's our benchmark, right? So it's a bit like the market's equivalent of a 1-year fixed savings account, right? But so just getting technical, SONIA swaps. So right now, we look at 1 and 2 year swaps, which is the basically borrowing money for 1 year or for 2 years, and 1 year that's at 4.82%, and what that means is effectively that's lower than base rates, Bank of England base rates. That means that there's expectation built in that those base rates will come down, which is probably net. Well, it's certainly the market expectation and probably what everyone expects. Then a 2-year swap, SONIA swap rate at 4.47%. Now, that's interesting. The reason I just dive into that technicality just for a second is, well, the last time we significantly moved our investor pricing was last summer, and those numbers were approximately 1 or a bit more than 1% higher last summer. So 1-year swaps last summer was at 5.81%. Against 4.82% now, almost exactly 1 percentage point, and 2-year at 5.67%, so 120 basis points higher than it is right now, 4.47%. So I guess why I'm saying that is that the benchmarks are lower than they were last summer, right? So and that's on the SONIA basis, so comparing that cost of money. Let's get things less technical, right? And say, okay, well, what can you get in a 1-year fixed savings account with a deposit-taking bank under FSCS protection, right? Last summer, the best buys on Money Saving Expert was about 6.1%, something like that. And right now, again, same source is 5.16%, 5.13% to the second. So you're talking about you can get a 1-year fixed savings account and you'll get about 1% less than you could last summer, right? Again, because of interest rate expectations. Now we look at loads of other things, but that is a good illustration to say, do you know what, net, the risk premium should be set against sort of those. And net, I think us and probably the sector as well, depending on how on it they are with their benchmarking, is probably going to shift downwards on interest rates. And I think everyone would understand that, you know, we've just seen much more encouraging inflation rates in the UK on CPI at 2.3%, and there's a downward trajectory expected on base rates. And one would expect that the rates that platforms are offering, certainly rational platforms, should you know, that's the direction of travel. Okay. So I'm not saying that we're going to tank our rates, but that's the direction of travel that we will probably be heading in, and much of the sector, I think, also will. But just a final point on that. I sound like I've massively overcomplicated the answer to this to that question. Okay, but what we try to do is think about it in the complicated manner that we do, and in a thorough analytical way, and then keep it simple. So 9.5 to 10.5%. It's the same for different products. You're in that loan, and that's the rate it is. It's a simple interest rate, and we keep it easy and clear on our platform.
Okay. And your loan. Go ahead.
Sorry, actually, I always do this, Lawrence. I'm so sorry.
That's okay. We've been doing this for years, Mike. I fully expect it.
The other thing to say, okay, if we just step right back from that, right, is the dynamic and the relationship between investor rates and what the borrower pays. right? And we want to keep our borrower rates on point, sharp, and competitive in the market, right? Now, that's because we want to compete for the best development finance facilities out there. It's not because we want to lowball or underprice development risk. We want to make sure we can close the best property development finance deals we can. And that is effectively a price competitive market. It's service competitive as well, and we add a lot of service and understanding in it, which is an important differentiator. But us bringing those rates down on the investor side, it is making sure we are competing in the market for development finance and great development finance deals. So there is that really important relationship to understand between the two.
Yeah, that's an important point to make. You have to remain competitive, understood, so rates have to be adjusted as such. So let me ask you this, since we probably spoke about a year ago, Mike, have you changed your lending criteria at all since, say, a year ago?
Not in any material way. Again, I'll sort of unpack that in quite a bit of detail. So we have our credit policy that generally tightens as we learn, as we iterate, through that 10 years of experience of lending, we feel that organizational experience just is getting stronger and stronger and stronger to secure better products. But what I am going to do, because this is kind of like, if you think rates to borrowers plus lending criteria, right, is very much linked to origination, right, finding those deals. And I'm going to just delve into the UK property market just for a second, right? I promise you, it won't be my normal 17 hours and slides of what I love to talk about. But let's talk about origination and deal flow. So, 2023 was packed full of macro uncertainties, right? There's inflation running. There's where's interest rates going to go, et cetera, and that drove lower confidence amongst developers to be out there shopping for new sites, right? So generally in the market, there were fewer developers looking to buy and to build, and they've had a reasonably tough time. They went through various labor constraints, activity constraints, material cost inflation, and this time, probably 2023, one of the things they thought most about was, am I building at the right time to make sure that in 18 months' time I can exit this thing, I can sell it, right? And one of the biggest concerns with that is where's the cost of capital for mortgages, and who's going to buy my end product, and are they going to be able to afford it? And when all of those things were moving so much, you've got premium and SONIA swap rates, but you've got higher mortgage rates and less competition in 2023, right? So fewer sites were getting transacted on and built, and we can see that. One thing is housing has great lead indicators because it takes 15, 18 months to do a project, right? And we already know that because of 2023 and that uncertainty, then 2024 and 2025 is going to be low delivery, low output of house building, right? We saw that completions, one measure is finished homes, right, were 8% down in 2023. Let's step back one lead indicator and starts, housing starts, so the ONS report on both of those, housing starts down 11%, right? And then let's step back even one further, planning approvals. In terms of units that received planning approval, it was down 18% in 2023. And I think that's staggering. One of the things that the UK has always been spectacularly good at is building 200,000 homes, right? Therein lies our issue that we need to be building 300,000, and that grows and grows each year because you're cumulatively short. And And we already know, based on what started, that 2024 we're going to be short of probably 100,000, and 2025 is likely to be with that planning lead indicator. So, that's and this will be a big election battleground. Let's not dive into politics, but that will be a major point. And what we also saw in our pipeline of bringing new deals to both our institutional investors and also our platform investors is that we found developers who had agreed a price and had agreed a deal with sellers. They sat in our pipeline for longer, right? They kind of thought, wait a minute, I've agreed a deal. I've almost got a free option to go slow, right? And I'm going to go slow because what I want is a little bit more certainty before I kick off in terms of that timing to actually buy it and then start that project, right? So we saw two things: fewer developers out there, and those that were out there shopping, and those who had shopped were going slow through the pipeline. And that impacted market completions, and it impacted the origination that we could bring to our platform for our investors. The good news is that there's definitely less uncertainty now, right? Less uncertainty is probably the way to describe that. There's greater clarity on inflation. Certainly, the results 2.3% was a step change improvement. And remember, that's from April, so that's actually includes data point from over 50 days ago now. Interest rates probably comfort on the direction of travel there. Property transactions, the activity, deals agreed are back up to 2019 levels, which is really the last sort of normal reference point, given all of the once in a lifetime events that have been happening. And the mortgage market's got more and more competitive, and more developers are out there, right? And out there shopping, and one of the things that I really did not expect was actually the confidence that came back into that market. So to bring that up, so we've had constrained supply to our investors, right? But in March, we set a record application month. So the 6 months leading up to March, we would get about 260 million pounds worth of applications a month, right? And that's a lot. But we we convert a low proportion of that, and that's good because we collect data and make sure that we're picking the right ones very carefully from a wide set, and that helps us building machine learning algorithms, etc. Out of that. But so 250 million, roughly on average, for 6 months. March, record month ever, 394 million. Pounds worth of development finance applications. Wow, is that a blip? Is that a catch up? Well, actually, then April smashed that by 20%, and we had 473 million pounds worth of applications. May is already looking like it's going to be north of 400 million. So we've seen our 3 biggest ever months of applications. So what that means is there's more people out there wanting to do things. We're going to bring more to the platform, and all of those on all of our quality measures are higher quality than we've seen over the last 6 to 12 months. So we're excited about bringing much more to the platform. So I guess that sort of wraps up a bit of perspective to say, right, okay, well, where are we sort of directionally on bringing new deals? Because that's what we've always had. We've always had a challenge from investors to say, bring us more deals. But we hold our underwriting criteria tight, rigorous, and we will only convert a small fraction of that to bring the very best to the platform.
Okay.
Now, the only thing I'll add to that is just to say that all of that also applies, and we'll go into this, I'm sure, in a minute. All of that also applies to active loans and the sales cycles of active loans coming off, whether it's a refinance or whether it's selling those units. That macro piece impacts that.
Mm-hmm. Okay. So let's talk a little bit, and don't worry, we're going to get to what's going on with the loans currently and some of the causes of probably the past terms, maybe things that are in default. So we are going to touch on that. There's a lot of people in the chat, obviously, who are investors and they want to know about that. So just hang tight. We're going to get to that. I wanted to ask you, does Crowdproperty still invest in its own loans?
So we don't as a policy, no. If directors are, then it's through Auto Invest. So there's no.
So it's kind of like a private thing. They're not doing it as a company.
Exactly. No, that's right. And some of our remuneration is linked to the success of those loans. So there is clearly incentive on Crowdproperty in the short term, as well as obviously the strategic, medium and long term. CP Capital, our mezzanine finance platform that we've done less business with in this market over the last 12 to 18 months, that has a specific policy that at least one director participates.
Okay.
But just to be clear on all of that, any conflicts are managed internally. So, e.g., if there's a recoveries decision on a loan that a director is a part of, that goes to independent. Make sure there's a quorum of independent decision makers that might go to the independent non-exec director, et cetera, et cetera. So there's all of those sort of policies in place.
Okay. So, Mike, let's talk about the loan book and its current situation. Can you talk a little bit about how the loans have performed during 2024? And then once we get into that, let's talk about the ones that are in past term, maybe some of the circumstances that are causing those situations to happen. We know it's property development, financing, things always tend to run over time. But let's talk about, how is the loan book performing this year to 2024 currently?
Yeah, so certainly. I the first thing to really emphasize here is that yes, property development is risky. Number one. Number two, they are projects, and by definition, projects do often overrun. And I'll bring to life some hard statistics on that. But the market context says, well, look, if there were fewer people out there shopping for houses, so owner-occupiers or investors buying houses in 2023, right? Because of that cost of capital, the mortgage rates went through the roof, then the sales cycles are going to be longer, right? That's just a fact of that. The other overlay to that is that the sales cycles take a reasonable amount of time to flow through. So, for example, the mortgage market got much more competitive and much more on point price-wise in January. So December, January, February this year. That's when it really started making the headlines, right? Mortgage market competition, there's more money wanted to get deployed, etc. So there are more buyers out there. Now, if they're getting confidence in January and they're saying, right, I want to buy a property, and they agree that price in February, well, guess what? That doesn't transact until May or June. So that's where the sort of, there's a slower transactions, then there's transaction recovery to agree a price, and then there's the completion of that deal. So these things take quite a bit of time to sort of wind through. And we can see that from the paybacks that we've had in our platform. So we communicate what we pay back each week to our investors. But if we just look back at the history of that to bring some numbers here. So in Q3 2023, we paid back 16.7 million. In Q4, we paid back 12.5 million. And in Q1 2024, we paid back 9.5 million, right? And that Q1 this year, i.e. January to March, that was very much to do with fewer deals being agreed back in Q3 and Q4 2023. So we see the end result of that. It takes time to bounce back. But we're seeing that activity right now, and I'll break down the late loan book in a second. But just as an FYI, and look, all of the numbers, especially expected numbers, are very caveated because property transactions move around all the time. right, and sort of pinning those down. But roughly, we're expecting in Q2 2024 around about 30 million of paybacks versus 9.5 million in Q1. Now, there's probably going to be a range that could be 20, 25, 30, maybe a bit over 30, but that is a material, whatever that number turns out to be, that is a material step change to Q1. And that is a direct result of more transactional activity going through to completions in the market. So we see that all over our book and the way we actively manage the portfolio. So let's give a few sort of statistics on the book then. So I mentioned earlier we've had 237 million pounds paid back, right? And of that, 58% was paid back on time or early, roughly on time, within a tolerance, and 42% of that was paid back late. They're projects. We actually expect that. Okay. Now, in those numbers, there's a positive skew in that paid back book to those which are getting paid back on time or early, as is a positive skew in the active book, right? Because there are more later running loans left, therefore, in the active book, right? So when you look at your active book, you're thinking, okay, I've got a higher proportion than I would expect of later running loans in my portfolio. And that's because later running loans stick around in your portfolio for longer. This gets further exaggerated when we consider sort of total length, because the later running loans are also more fully drawn facilities, okay, because they're more progressed. We've released more money, okay. So capital-wise, you get a skew of the weight of capital in later running loans, and we haven't filled up all of the earlier phases. And then in individual accounts, this gets further exaggerated, especially if deployment has been slowing down. So, for example, if people have been waiting for repayments to reinvest, right? Or there's less capacity available. We talked about the origination of new loans coming. There's less capacity available to invest, which constrains the amount of new loans they can put in. And also, if people are slowing down their investment for other reasons, right? So all of that means that your sort of denominator of total portfolio, right, is lower, and there's a skew towards the later loans. So that's where actually one of the emails we sent recently around risk management, just to explain that, really sort of went into look at the way to look at your account and understand your account and really say, right, okay, what is my late loan book and my proportion of late loan book as a proportion of my total lens, rather than just my outstanding portfolio, to remove some of those biases and the skews based on the natural dynamics of those loans. And we have our account pages. So there's a table. I mean, on our account pages, we present things in different ways. We have tables and we have graphs, because some people prefer tables, some people prefer graphs, right? And one of the key sort of bits of an account page is the waterfall chart of the active portfolio, right? And the table right above that is a crucial table that says, right, in all, you've lent X in total, you've had Y paid back, you've had Z interest, and then there's the active portfolio, and then that's what the waterfall breaks out. Okay, and if I just illustrate that for a second, and I'll break down the stats in a second, but if I just illustrate that, so if say you have you invest in 4 different projects and you invest £100 in each. Right. It's possible 2 of those projects pays back on time or early, okay, and therefore £200 plus interest will be repaid on or before that contract end date. This means that 2 of those projects are then outstanding, right? And of those 2, one maybe pays back 3 months late, right? And maybe It's now 12 months after they should have paid back, and you've got one outstanding loan, right? If you look at the waterfall chart, 100% of your active portfolio is over 180 days late, right? However, that's 25% of your invested amount. So it's just a really important way to look at the data, especially on the account pages. But let's talk specifically about that late running book. So we're obviously actively managing those loans through our portfolio teams, through our watch listing process, through our early warning indicators in managing those, and escalation to credit and other formal methods of recovery. But we currently have 36 loans that are over 180 days late. Okay, now that's circa 8% of loans ever written. Right, it is circa 8.5% of the facilities agreed, and all of those are first charge secured. And of those 36 loans, we are working them hard, and 36% of them have partially repaid in some way, shape, or form. Right. So some element of the asset, might be 1 unit out of 5, whatever, has exited, and they are, it's proven that the developer is creating value and exiting something. Right? That's an important measure. 64% of those 36 loans have an exit in progress. So that's one of our status flags in our early warning indicators. So an exit in process, so that is progressing through to exit, right? And 50% of all of those loans in the 180-day late bucket are in legals pursuing those exits. So really, what I'm saying here is that there is a reasonable amount of loans. 36 loans is material. Remember, we've done 453 in that 180-day late bucket. And our crucial job throughout all of our portfolio work is to make sure the developer is adding value, right? There's an asset value to it that has as broad a market as possible appeal, so that we can get to an exit, we can drive to an exit and crystallize that capital and the interest. Right? And that is the core of our work, absolutely core. And all of our sort of credit function analysis, etc. Right? We are expecting, we crystallized one capital loss, right, which was circa £40,000. That's on our statistics page. There'll be a few more, definitely, but that's all to be expected within our communicated tolerance of 1%, and we've always said that is a typical property development capital loss factor of 1%, and we expect to be within that. And remember, as I said earlier, there's a premium rate for any loans that are going late, and we've already crystallized a 23 basis points premium versus the promised contract rate. So we are driving these home, and as I said, this quarter could be 20, 25, 30 million of redemptions versus 9.5, and that is very market-led, those exits, with the transaction levels coming back to where we feel they should be.
Okay. Can I just ask you a quick question? Can I hop in? Something that sprung to mind. If a loan is considered in default and it's 180 days behind due, and that developer pays back, say, 50% of that loan, it still continues to show as being in default at that point, right?
Yes.
Okay, yeah. So that's going to make a difference then.
Very much. And also, we don't reterm any of our loans either. We don't rebase it based on agreed extension or whatever. All of our reporting is based on originally contracted end dates, and that's important for transparency as well.
Mm-hmm. Okay, so, and I think a lot of people, they don't understand too with property lending that. I think you make a really good point about the 8%. It's sort of kind of a standard. It seems like some of the platforms I've spoken to seem to range between 8 to 10% of what loans tend to run into problematic areas of time repayment, and also the 1% of capital losses, because we don't tend to see a lot of active platforms serving up capital losses. So I think people have kind of become used to not seeing any capital losses and forgetting that when you're getting paid 9 to 10% in returns, you're going to be taking on risk that will likely at some point result in some kind of a capital loss, and just people are not used to that. I mean, there's the people like us who have been used to the lending losses, which have been 95% capital loss, but not so much on the active platforms that are trying to perform well. I think it's an important point.
Yeah. Exactly, and that's exactly right. Look, we work very hard on this piece of our business because this is the bit that matters, right? Is getting these loans back. Now there are various degrees of action that one can take to recover these loans, and one could say, well, look, have a hard and fast rule, okay, blanket rule. 180 days, put it into receivership, right? And that would be entirely the wrong answer, right? You have to case by case understand the situation, understand the exit strategy, understand where that developer is, what it takes to finish that off, what it takes to put that asset in as wide a market appeal as you could possibly do.
Somebody made a comment in the chat about the user interface being, I think, a little bit complicated to decipher what loans are at what point. Do you guys have any plans on maybe trying to design that user interface to be a little bit more friendly for usage?
Well, and we took a number of points on board because I mean, we really welcome feedback and ideas on all of those, and we introduced that you can click through on each individual project and see all the updates, so it's much more structured, and then issuing those updates and reminding people of those updates are then present. So because actually, property development, it very importantly, is both quantitative and qualitative as to where that project is, right? And we've tightened up on the frequency of updates, and how easily people can access them, so they can be clicked through on the portfolio account, and that's important. One of the challenges, of course, with diversification and having an average of 88 loans in the book, and that's 88 different projects, I should say, which might be multi-phase, so there could be hundreds of line items in people's accounts, is actually crystallizing that and making it clear, and that click through into each individual update is really important to bring that to life. And we'll update on material developments and on a frequency basis as well.
Okay. So at what point, Mike, do you say that this loan has run too late? Because I've noticed some of the loans in the portfolio are now, way over the 6th month past. Some of them are, I think, up to maybe 12 months past term. When do you draw the line and say we have to at some point take some action against these loans that are late?
Yeah, and we've taken a number of projects into receivership, and historically we've taken things into receivership and achieved full recoveries. It basically comes at the point where you say, right, we do not have confidence in the developer's finishing strategy and exit strategy, right? And that is a judgment call by expert property people within our business, and that will have been concluded from a lot of working very closely with that developer to make a judgment on, right, we now need to call this in, because a loan could go 18 months late, right? And have an LTV cover that we're comfortable with, have a security that we're comfortable with, have progress or finished asset that has wide appeal to the market, that we understand has had a slower sales cycle or a slower refi cycle, or all of the sort of the nuances that we see on a case by case basis to make best judgment for our investors' capital. Right, that is the art, both art and science of our recoveries function, to understand that at a granular level enough to make best call on it. Remember, you put something into receivership, right, and the receiver's fees come out first, right? So you're immediately, on the back foot in terms of recovery. That doesn't mean that we don't want to take that course of action, and we have taken that course of action. But we do so with very clear options, with robust debate internally, with property expertise at the core to make that best decision on a loan by loan basis. Look, the handling of overdue loans requires diligence, experience, skill, etc., to really drive home an efficient completion and exit. And there's a lot of work that goes behind the scenes on our portfolio teams, on our credit teams, our property teams to make those best calls.
Okay.
And I guess just to add, this bit is so fundamental, right? Where progress has slowed, right, or difficulties encountered, we can see that. We know that because we're visiting the site. The independent monitoring surveyor is visiting the site. We have a suite of early warning indicators to make sure that we're prioritizing our resource in the right way. But we will specifically meet with those borrowers to discuss available options, thinking about what are the best options for completion and an exit here. And that could be not only support on the project itself, insisting on project manager is inserted onto the site, or other skill sets into the team, into the capabilities, but also where they might need top up capital, whether that's an introduction to an equity partner or mezzanine finance. We're working at restructuring the team. We're working at resequencing plans that they have, introduction to other finance providers for refis. All of these options, these suite of options, are on hand for our portfolio teams as we work closely with those developers.
Okay. So let's talk a little bit about, and I think we can kind of round this up by saying, well, a lot of investors on our side, we get nervous because we've seen competitors of Crowdproperty sort of having the same kind of issues and falling into that black hole of non-transparency. And all of a sudden, we've decided to either shut the doors to the peer-to-peer lending retail side or just completely disappear. So I think it's pretty normal that they get a little bit nervous when they see loans that are 12 months or 2 years past due, and they start thinking, yep, well, is the company itself okay? What can you say to people out there that might be calm their nerves a little bit about those loans that have really gone way past you and are trying to be resolved?
I mean, I'm sort of, I don't want to reiterate exactly what I've said, but there's hundreds of years of property expertise that go into making the best decision on a loan by loan basis, right? And it is a very, very challenging balance because, as I said, we could just systematically put something into receivership, right? Okay, it's actually working that through to the best outcome, and the best outcome is typically achieved when it is the existing developer executing with the existing contractor on that site to the existing plans, right? Typically achieved. I'm not saying in all cases, typically, right? And so we need to exhaust all options to support that. And if that's not going to work, we lose confidence in the team, the strategy, and the exit, then we will act, right?
Sure.
That's core. And that only comes, making best judgment only comes from a lot of experience. A lot of experience.
Okay. Yeah, and I think you've covered this really well. The thing I always say is sometimes you got to practice some patience and let the results come out and let you guys do what you do. We don't have the experience. We're on the outside. So we have to let the people who have the experience do what they do. And it is a very complicated system. I don't quite think people sometimes don't understand how difficult and how complicated it can be to lend money to developers. But let's talk a bit about Crowdproperty as a business. How's the business doing itself? Have you guys been profitable on a monetary side as a business operation side?
Yeah, so I mean, we've been profitable for the last 3 years, and you can see in Companies House accounts, we write a fairly good strategic report on that to summarise that, and to really summarise the drivers and the risks that we are managing. But importantly, that is whilst continuing to invest in our business, right? This is the challenge of high potential, potentially scalable businesses. Is you're always balancing that crystallization of profit versus investing for the long term, as well as funding the operations on a month by month recurring basis. And look, we've got pretty clear vision on this. I won't go into it in the absolute length of detail that I sometimes can, but we see huge potential here as an asset class specialist. At the end of the day, we are a development finance business, right? And we enable many different types of capital to participate in that. We don't see ourselves as a peer-to-peer lender so far as a marketplace lender. No, we have to be an asset class expert, because that is the core of our business. Finding great developers, lending, managing, redeeming, right, with expertise, and then we allow or sort of facilitate different parties to invest in those. And the really interesting thing here is you're right. Property development is hard, and originating, managing and redeeming property development loans is hard, right? And the really interesting piece here is that we came into this market because we saw small and medium-sized developers struggling to raise finance, right? Now, why did they struggle to raise finance? Now, interesting, years ago, decades ago, the banks said, "Oh, this is quite hard. This asset class. I've got say 100 loans in my active book." It's like, it's really hard to build systems to be able to cope with more loans in the active book. So therefore, one route to growth is, well, I'll still do 100 loans and I'll manage 100 loans, but they'll just be bigger loans, right? That's a route to growth, right? And we've seen that, and both in the banking sector and in the non-bank lending sector in this space, development finance businesses who are any good, they find it very hard to scale on number of loans. So they go for the size of loan, right? And what that does, it leaves, in our view, the smaller loans, so the smaller medium-sized developers, so the sort of the £1 to £5 million facilities, or £500,000 to £5 million facilities, right? It leaves a really fragmented set of development finance lenders who are typically spreadsheet lending. They're not very scalable. They're doing a bit. They might be on their own account. They might have a little source of capital, whatever, right? But it's fragmented. There's no dominant player there, right? And we see the power here of becoming that dominant player, right? And cracking that problem of being able to deal with many loans. And as I said, 453 loans, right? 315 paid back, right? That is an exceptional track record in this space, right? And that is what we're building core into our business, and that's what we're investing in, right? Mm-hmm. And so whilst on a day-to-day basis, on a month-to-month basis, we think about that investment as growing the experience within the business and our operational excellence. We're ever scrutinizing those applications more. We're ever scrutinizing the active portfolio more. And that results in a strengthening market position, and it's a virtuous circle to attract more lending and to be great in that space. right? So, but from a more strategic level, what we're investing in as a business, to really drive scalability and to dominate that small and medium-sized development tranche, right, is we have a very clear 3-year strategy. If we didn't, then quite frankly, I should be fired, because I used to be a strategy consultant for many years. So strategic direction and focus should be absolutely pinned down at Crowdproperty, and that's absolutely right. So we focus on 4 major things, right? First, strong people and culture within our business, expertise and a rich culture in our mission of backing small and medium-sized developers. Building scalable systems and processes, truly scalable in this complex asset class to manage, right? And that takes brilliant engineering talent, brilliant analytical talent to bring together what does that workflow look like and how is it done most efficiently, right? Then overlay that with the third piece, which is robust governance and control, right? Really bringing in that absolute rigor, great governance, great structures in our business. We've got a very strong board, very experienced board and executive committee, as well as our property expertise at the core of the business. And then finally, exceptional customer relationship management on both sides of our marketplace with developers, and also the multitude of types of investors that we have, both institutional investors and also platform investors, which I should add, we place platform investors as a strategic core of our business.
Okay. Let's see, we've been going for about a little bit less than an hour, so I don't want to keep you on here forever, because I know you love talking about, you'd sit and talk about this for 4 hours if I let you. But I got a couple of other questions, so I just want to have a little quick fire, bang off these last questions. We'll ask a couple from the people who put in the chat. Okay. What's your position on continuing to serve the retail sector? I know you mentioned institutional. Do you plan on continuing to service retail?
Very clear answer, yes. Okay, I'll just unpack that a little bit. Just bear with me.
Go ahead.
We have institutional capital. Institutional capital looks for great lenders and great asset class experts with great track records. It's hard to close. There are very few people with institutional capital, next to none that have institutional capital that is deployed alongside retail investors, platform investors, and we have many sources of that across global asset managers, banks, and platform investors is very much core to the future of our business.
Okay. Peer-to-peer lending sector in general, bullish for growth or bearish for growth?
I just don't think about peer-to-peer lending as a sector.
No.
Right. I separate the marketplace. So we are a specialist development finance business, right? That is brilliant at that, right? And then we enable different classes of investors to deploy capital into that in a diversified way that is accessing what is fundamentally a hard to originate, hard to manage, hard to redeem sector that is lumpy. So if you fractionalize that and get diversified access to it, that's a really interesting way to invest.
Okay, got it. So you're not thinking about things on a peer-to-peer level anymore. It's just your specialist lending company that offers people a way to invest in things that 15 years ago they wouldn't have been able to do. So we'll sum it up as that. Sound fair?
Exactly, because we compete against other development finance businesses on that side, and against different investment options for institutional capital, for banks, and for private investors.
Okay,
right? They are separate markets, effectively.
Let's see. I think we covered, most of the things I wanted to cover. Let me go into the chat here and see if there's anything that people want to ask you directly. We'll do quick fire off here so we can get you to the dinner table. I'm sure And are you finding more lenders entering into the arena, or is there still a lot of room in the market generally?
Good question. Again, I'd sort of separate the two sides. So I don't look at the sort of the marketplace lender, the peer-to-peer lender sort of bit. I think there are always more, especially bridging providers. It's a very, very busy market into real estate. There are more of those, but general, like not just ones that open up to platform investors. Less so development finance, because that is you've got to build your entire business around it, which is what we've done. We're as I say, a specialist of dev lender. Are there more marketplace lenders like us? It's not shifting that much. I think, as we all know, there's been a bit of a clear out over the years, and over time, the cream rises to the top. A lot of organizational experience benefits that, and they get better and better and better. But it's fundamentally, as an investor, I would look at this as, right, who does that asset class well? Who has the inherent expertise there?
Okay.
I haven't really answered that question. I'm sorry.
That's okay.
I look at it differently. Yeah.
Totally fine. Any plans to introduce a secondary market?
Good question. Get asked this a lot. In our research, it's relatively low down the priority list. There are lots of what our investors want. Some people it will be important, some people less important. We get that. There are lots and lots of regulatory considerations around this. I think it's probably an area which will attract greater scrutiny from the regulator. Especially. I'm going to use just one example, right? How do you price set? How do you all of these sort of things, right? But it's a physical asset class, right? And if you are advantaged, if you're next to one of our development sites, right, or you drive past it or whatever, right, and therefore you might choose to either sell or to buy that particular one based on your own observation. Right, and so there's information asymmetry, and I think that all of the challenges around secondary markets, right, that is a pretty specific one to real estate as well, and there are bucket loads of challenges. So, sorry, again, that's a long answer to say that is low down on our priority list.
Okay, fair enough.
For very rational reasons.
Yeah. Let's see. This is one that. Chris sent in via email. He had 5 questions, but I'm going to ask you one for the sake of time. He says, why do monthly interest-paying loans stop paying monthly if a partial capital repayment is made by the borrower? Does that make any sense?
It does. Could I don't have that answer front of mind.
Okay.
Apologies, Chris. But please do get in touch, and we'll get the right people to make sure they clarify that point with you.
Okay. So what's an email address that somebody could, if they wanted to send some questions to?
hello@crowdproperty.com. If you go to our footer on our website, there's both contact email and also phone numbers straight into the investor services team.
Okay, perfect. And one more question, then we are going to wrap this up. Any possibility to make all interest payments happen on a day of the month, similar to other platforms, rather than have it drip in at different times during the month?
Yeah, and that's a fair feedback. The one thing is there's quite a transactional volume consideration there. Hundreds of loans times loan parts times 1,000, 2,000, 3,000 investors. It gets quite draining on server power and payment. So it does logically make sense to spread that through the month. But I'm going to counter my own point there. I can see why that would be convenient for investors, especially if they're in average 88 loans, then not having that dripping in and having that on a set day, or at least a more compressed timeline, is a good thought. And I'll raise that internally. I don't think that's a short-term fix, but certainly thank you for the suggestion.
Okay, there you go. So hopefully that wasn't too painful of an hour for you, Mike. I know I asked you some tough.
Always a pleasure.
Well, we put you out here. Everybody likes the transparency. I know sometimes people are not going to hear the answers that they want to hear, but we do our best to try to present that transparency of information to everybody watching. And you do have a lot of people that are positive about Crowdproperty and have really enjoyed what you've done over the years. So always remember that when you get the little negative points that are, my loan's 2 years, my loan book's 2 years overdue. I know what it's like.
And we entirely understand that, and it is an inconvenience, and it is concerning for individuals looking at numbers on a website, right? But what I can commit is that our team is working expertly and very hard on each and every one of those loans to bring them in, and to bring on new lending opportunities as well.
Perfect. Well, for anybody that doesn't have a Crowdproperty account or wants to open an account and have a sift around the platform, you can do so at crowdproperty.com. And thank you again, Mike, for coming here. Hopefully have you back on and within maybe sooner than a year. Just to, maybe we can do a 6-month update on how the loans are going, and if you're open to that.
And Lawrence, I think that's an excellent idea. So let's do exactly that.
Okay. Perfect. Well, thank you again. You have a nice bank holiday. It's bank holiday weekend, isn't it? Is that right?
It certainly is.
Are you taking a day off?
Yeah.
Are you taking a day off?
I'm not very good at taking time off.
Yeah. You're a workaholic. Oh, goodness. Yes. Take a day off. You deserve it.
Yes.
All right. Well, we'll talk to you again soon. Thanks again, Mike.
Okay. Thank you. Take care.
Bye-bye.
Much appreciated.
Okay, so there you have it. That's Mike from Crowdproperty giving us the answers. Hopefully, I always say actions speak louder than words, so we'll see what happens in the upcoming period of the next month, see if they can get a handle on some of these loans that are past due, which, again, is completely normal in the crowd business, property lending world. I know from experience it can take quite a long time, but still nonetheless obviously concerning, and so I'm going to do my best to keep on top of that for you. Hope you enjoyed the stream. If you did, please hit that thumbs up button. These streams are not easy to put together, and I hope you really enjoyed it. I'll be back next Thursday on the 30th of May. God, can you believe it's almost June and that half of this year is coming to a close already? That's crazy. But I will see you in 7 days' time. Again, thanks to Mike for doing that. Good evening from Harley, the hound dog sponsored by Cufflink there, the cam. And hope you enjoyed it. Thank you very much to everybody for being here and for supporting Financial Thing. And that is all I got for you this week. So we'll speak to you soon. See you next time. Bye-bye.